Many founders focus on building products, finding customers, and growing their business. Most startups fail not from bad ideas but from ignoring their numbers. Accounting isn't just paperwork, it's the story of your business. Here are 9 simple concepts every founder should know. Many founders start a business because they are excited about building something useful. Their attention usually goes to customers, products, and growth. Because of that, accounting often feels like a complicated task that sits outside the real work of running a business. But accounting is simply the story of your business written in numbers. When founders you understand a few basic ideas, those numbers stop feeling intimidating and start helping them see what is really happening inside their business. Accounting is simply a way to record what happens in a business. Every sale, purchase, expense becomes part of a record that describes how the company operates. You can think of accounting as a simple process. Something happens in the business, it gets recorded, and later it appears in a report. Those reports help founders compare their expectations with reality and make more thoughtful decisions. Every accounting system is built on 5 ideas. These ideas help explain how money moves and what a business owns or owes. Income shows what the business earns, expense show what it spends, assets represent useful resources the business has, while liabilities represent obligations that must be settled later. Equity reflects the remaining value connected to the business. Revenue represents the money a business earns from selling products or services. Expenses represent the costs required to keep the business running. When founders track both regularly, they start to see how their business operates over time. These numbers help reveal patterns and make the overall activity of the business easier to understand. One concept that surprises many founders is the difference between income and cash. Just because work has been completed doesn't always mean the payment has arrived. For example, a company may deliver a service today but receive payment later. Accounting records the equity when it happens, while cash flows show when the money actually moves. Assets represent the resources that help the business operate or grow. These may include equipment, tools, or other useful items that support daily work. Liabilities represent the commitments the business needs to fulfill later. Looking at assets and liabilities together helps founders understand how their business is structured and how resources are balanced with responsibilities. Businesses usually organize financial information into 3 main reports. Each one explains a different part of the financial story. One report shows how business performed during a period of time. Another shows what the business owns and owes at a specific moment. The third explains how money moves in and out of the business. Many accounting problems come from simple habits rather than complex situations. For example, mixing personal and business spending can make financial records difficult to understand later. Another common issue is delaying financial tracking until information becomes hard to reconstruct. Consistent tracking helps founders stay aware of what is happening inside their business. Founders do not need complex systems to build understanding their finances. What matters most is building simple habits that keep financial information clear and organized. Recording transactions, reviewing numbers regularly, and keeping documents structured can make a big difference over time. When founders understand the numbers, they gain a clearer picture of how their business is evolving. Thank you very much.